Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Schwan, and in each episode I share my thoughts on a topic or recent development relating to South African tax with you. And I'll do my best to do it within the time that you need to make a good cup of coffee while you are taking a break from work. Our topic for today is exit taxes. Now, of course, this is something that's very relevant to South Africans who immigrate. So let's start at the beginning. What exactly is an exit tax? Now, it's not a concept that's defined in the legislation or even referred to by this name in the legislation. What the law does say is that when a person ceases to be a resident of South Africa, that person has got a deemed disposal of their assets on the day before they cease being a resident, and this deemed disposal is deemed to occur at the market value of the asset. So if we are looking at an asset that's a capital asset that would normally attract capital gains tax if it were to be disposed of, the deemed disposal would also trigger the capital gains tax on that asset, and the capital gain would be the difference between the market value of the asset, being the deemed proceeds, and then the base cost of the asset. Now, the base cost would be determined using the normal principles one would use to determine base cost. So in most cases, it would be whatever the person paid for the asset, but if, for example, the asset was acquired before 2001, there's a bit of a more complex formula to determine the base cost. So all that the exit tax really refers to is this tax that results from the deemed disposal of a person's assets when they cease being a resident. If you don't mind, I would just like to sidetrack myself a bit before we continue. And that's just to mention that the deemed disposal is not limited to individuals. It could also happen for other entities like companies or trusts. So these entities can also cease to be resident. So unlike an individual who would immigrate, these entities, their residence depends on other factors. So if, for example, the place of incorporation of the entity changes, that could affect their residence status. Or it could be that the place of incorporation remains the same, but because of the way that the entity is now managed and controlled, it's considered to be a tax resident in another jurisdiction. And one would then need to consider the double tax agreement between South Africa and that jurisdiction to determine where the entity would be exclusively resident. Now, as you may know, a lot of these double tax agreements use the place of effective management as the tiebreaker provision. So it could be, and this is the link back to the individuals who immigrate, that if an individual who is a trustee or a director of these entities move abroad, that they start to manage and control the entity from abroad, and this results in the place of effective management moving, which could then in turn result in the entity's residence ceasing to be South African. Now, as you can imagine, this depends on quite a few factors, so it's not to say that whenever a trustee or a director moves, the companies and related trusts definitely also cease to be residents. That's definitely not the case. So it depends on how the entity is being managed and controlled. It depends on the laws of the other jurisdiction. It depends on even something like the specific double tax agreement and its tiebreaker provision. So, but it is something to be aware of and to be on the lookout for if a person immigrates. It could be a consequence of that immigration. Right, let's return back to the exit taxes now. Some good news about the exit tax is that not all of a person's assets are subject to this exit tax. So some of the assets remain within the South African tax net and would still be subject to tax even if they are disposed of by the person as a non-resident in future. So these assets would include the immovable properties situated in South Africa and any assets attributable to a permanent establishment in South Africa. So you may then wonder, but what assets are really affected by the exit tax? So in my experience, the assets that are most affected are investments. could be local investments, foreign investments. So these assets would be outside of the South African tax net if they are disposed of by a non-resident. And then I think we need to also distinguish between some of these investments are more liquid than others. So if we take, for example, an investment in, let's say, listed shares or unit trusts, those kind of things, if there is a deemed disposal and there is some capital gains tax payable, no one likes to pay the tax. I don't think I've ever met a taxpayer who really likes to hear the fact that they need to now pay tax, even though they haven't sold any asset. But for these liquid assets, there is a way that you can sell a portion of it to get the cash to pay the tax. The real problem comes in when we're looking at private companies. Now, a lot of these private companies, if the company has got a good underlying business that someone built up, but a very low base cost. So often what you find is that these private companies where someone started the business from scratch, they don't have much of a base cost. So if we then apply the principles of the deemed disposal, the deemed proceeds would be the market value of the company, which is based on a valuation of a sound, good underlying business, and this low base cost. So then there would be a real capital gain there, or significant capital gain. And the issue is that it's not as easy to sell these shares in the private companies than it would be to sell shares in a listed company or unit trust. There's no real market to just sell bits and pieces of shareholding in private companies. So that's a cash effect of the exit taxes that you definitely need to plan for. The same problem also arises on property owning companies. Now, this one is a bit strange in the sense that even if a non-resident disposes of shares in a company that owns South African property, that disposal of the shares would still be subject to capital gains tax. However, there's no exclusion from the exit tax for this. The reason for that is that there are some double tax agreements where it could be debatable whether South Africa is allowed has still got the taxing right to tax the gains on these shares. So to ensure that these shares do not escape the South African tax net completely without their value being taxed, they are subject to the exit tax. So the same issue that you could find with private company shares could also arise on these property owning company shares. Perhaps a last point before we close, some taxpayers and practitioners try to manage the effect of the exit tax, especially on shares, through, for example, transactions involving dividends. So to basically extract the value of the share out of the share in some way before the deemed disposal occurs. Now, I think what's important to remember here is that these transactions are often not as simple as one would think. So remember, dividends, for example, would have dividends tax on it, even if the dividend remains outstanding on loan account and the cash hasn't actually flown. If we look at foreign dividends, for example, there are also some clawbacks that could happen of the exemptions that previously applied to these foreign dividends. Right, so to close and summarize for today, the important takeaways from the session. I think the first one is that just to note that an exit tax arises from the deemed disposal of assets when a person ceases to be a resident. Second important takeaway is that this exit tax does not apply to all assets. And the last one is what you really need to look out for is an exit tax on illiquid assets. Those are the ones that are difficult to or could have a significant effect, and they are difficult to fund. So that's something one would need to plan for if you plan to immigrate. Right. That's all for this episode. Thank you for listening. And if you enjoyed the podcast, please subscribe on your podcast platform, and please also tell all your friends and colleagues about it. If you have any questions that you would like me to discuss on a future episode, you are welcome to email it to me. My email address is in the show notes. And perhaps just as always, nothing in this podcast should be construed as tax advice. or even be seen as a substitute for fact-specific tax advice. Until next time, goodbye.